Are you looking to buy a business with project-based revenue? If you are, you need to understand percent completion accounting. Percent completion accounting is a tool used to ensure that revenue is recognized at the right time. Let me show you how this works in practice. In this first example, we have a project where the contract amount is for $1 million. The estimated cost to complete that project, let's say, is $700,000. And let's say that to date, this company has expended $350,000 on this particular project. The final number that we'll need is the total amount that's been billed to date. In this case, let's assume that this company has billed $700,000 so far this year. In this case, because they've spent $350,000 on the project and they expect to spend $700,000 on the project, we consider them 50% completed with this project. That would mean that they should recognize 50% of the revenue. So that would be $1 million multiplied by 50%, which would give you $500,000. If we compare this $500,000 to what has actually been billed to date of $700,000, you can see that there's a difference of $200,000. We would call that our billings in excess of costs. That means we've billed $200,000 more than we've actually earned on this project. So in this case, you would want to see the $200,000 removed from earnings in that month. In another example, let's say we have a project that we expect to bill $500,000 for, and the estimated cost to completion is $400,000, and we've actually spent to date $300,000 on this particular project. But we've only billed $100,000 on this project. In this case, we would consider ourselves 75% completed with the project because we've spent $300,000 out of the $400,000 budgeted on this deal. That being said, we've only billed for $100,000 despite us earning $375,000, which is the 75% of the original contract price of $500,000. In this scenario here, we would have costs in excess of billings of $275,000. So in this case, this business on this project has underreported revenue by $275,000, and an adjustment would need to be made at the end of the month to make sure that revenue is accurate. This is a really important tool for two reasons in acquisitions. One, you want to make sure that in diligence, the company is properly recognizing revenue, and that way earnings and EBITDA are not either overstated or understated. You also want to make sure that at closing, you understand the amount of unearned revenue that you're purchasing and that you're being fairly compensated for that liability. If you're buying a business with project accounting, let me know and I'd be happy to send you this template or just talk through your particular deal and see how we can help.